Great. Thank you so much. Okay, so as most of you know, this is where we schedule, we call our industry keynote. Industry expert who comes in and bring us some enlightenment on issues facing captives or the broader world of the finance industry or economics. Well, this year I received a call from one of our esteemed captive attorneys here in Burlington, Kathy Davis, who said, "Hey, I just happen to know a guy who might fit the bill for you for your captive keynote speaker, this year." And when I researched her suggestion, I was of course excited, especially as he fits so well into the theme of disruption around the industry and the economy. As many of you know, Kathy is a partner in Downs Racklin Martin with many years of experience in regulatory and corporate law with an emphasis on insurance regulation. Kathy chairs the DRM Insurance Practice Group, which represents more than 100 Vermont captives. She's a past member of the board of directors here at VCIA and the NARA, and one of the leading captive lawyers in the business. With that, I'd like to ask Kathy to come up here and introduce our keynote speaker this morning. Please welcome Kathy Davis.
Thank you, Rich. Good morning, good morning. I'm very pleased to be asked to introduce our keynote speaker today because, as Rich just said, I suggested him. I'd like to give you a little personal background on Chuck. He grew up in Burlington, Vermont. And here's a little known fact. As a child, he was a late bloomer. He looked younger than he was. When he was 12, he looked like he was 8. When he was 15, he looked like he was 12. As a consequence, I think he had to be smarter, faster, and more competitive than everyone else. He had to focus and work harder, and he did. And he's carried that quality forward. Finally, when he was about 16, he grew about 6 inches in a few months. At that point, his athletic prowess improved such that he became an accomplished tennis player and soccer player. Again, he exhibited energy and focus. He attended UVM, where he played varsity tennis and varsity soccer on a very accomplished soccer team. As the number 1 singles player on the team, he won the Yankee Conference tennis title. He was an all-Yankee Conference selection in both tennis and soccer, and he was inducted into the UVM Athletic Hall of Fame in 2001. Chuck has run in at least 3 marathons, and in his fastest race, he broke 3 hours. But while he was at UVM, I don't think he knew where the library was. Then something clearly clicked. I know Chuck's business success has been due in large part to the wonderful role models provided by his father, Dudley Davis, a very successful Vermont banker, and his wonderful mother, Fitty Davis. And it was at this point in time when he met his future wife, Marna Olson Davis, which clearly made a difference. Anyway, somehow he talked himself into Columbia Business School and studied for an MBA there. It certainly wasn't based on his academic undergrad performance at UVM. Once at Columbia, he approached studying for his MBA with the same focus and determination he'd used to succeed as an athlete, and competed with his classmates to graduate at or near the top of his MBA class. He then accepted an offer at Goldman Sachs and went on to become a general partner very quickly there. During his 23 years at Goldman, he was head of the investment banking services worldwide and head of the financial services group, among other duties. During this time, Chuck and Marna had 2 sons, Tucker and Tyler. Chuck made a point to coach their soccer and hockey teams, take family ski trips and other vacations, and actively help raise the boys. He used energy and focus, as he does with all the important things. Chuck now serves as CEO of Stone Point Capital, a private equity firm located in Greenwich, Connecticut. Stone Point makes investments within the global financial services industry. It has raised 6 private equity funds, the Trident funds, with aggregate committed capital of about $13 billion. In addition, Stone Point has secured about $7 billion of equity co-investments since 2001. Stone Point targets investments in companies that provide services to banks, asset management firms, insurance and reinsurance companies, insurance-related services, mortgage services, and employee benefits and healthcare companies. Chuck serves as a director of some of the portfolio companies of the Trident funds. He also is a director of Axis Capital Holdings Limited, the Progressive Corporation, and the Hershey Company, and is a former director of other publicly traded companies, including the Marsh & McLennan Companies and the Merchants Bank of Vermont. He's a member of the advisory board of Deutsche Bank. He's also a pretty good golfer. So it's my great pleasure to introduce one of my two wonderful brothers, Chuck Davis.
Good morning, good morning. I think that's what Kathy said. You just heard a very slanted version of the truth. Now let me give you the real truth. Cheryl, Chuck, Jeffrey, and Kathy all went to the same grade schools and high schools and had the exact same teachers. And when Kathy came along, in the first week or two, the teacher would say, "Kathy, could I see you after class?" And the teacher would say, with great curiosity, "You can't be related to Cheryl, Chuck, and Jeffrey." And Jeffrey's here today because Kathy got straight A's her entire time, and her glossing over of my academic performance was nowhere near the abyss that it was. I went to Middlebury College. I flunked out. They invited me back. I flunked out again. They invited me back. I said, no mas, no mas. Kathy applies. They put her on the waiting list. I went down and said, you cannot punish this poor person because she's genetically related to me. And she went there and did spectacularly. So, thanks for the introduction, Kath. I am going to try to do a couple things this morning, and I hope this becomes interesting. And I've got questions coming here, I guess, like how come Kath isn't the keynote speaker and you would introduce her? But first of all, I want to thank everybody for your involvement in the Vermont captive world, because as a native Vermonter, this is one of the best things that's happened to the state in the last 25 years, and each and every one of you deserve credit for that, and we really appreciate it. It's done wonders for the state, and it's good, clean, high-paying, high-value-added job. So give yourself a round of applause. I'd like to talk about money, and I remember the first paper I ever wrote in 4th or 5th or 6th grade. I was writing a paper on money, and I had a coin collection, and our father was a banker, and I asked my father for some advice, and he said, oh, simple, money's a commodity. Well, that was really helpful to hear, because I had no idea what that word meant. And I have studied money my whole life, and I don't know that a half a century later I know any more than I did then, but I find it to be fascinating, and I'm going to try to frame what's going on in money and the world, and then relate it to insurance, and then talk about some of the disruptors that Rich referred to, and others, and be delighted to get your questions either live or electronically. So who knows how much you get paid to invest in a German government bond today? You get 2%, 4%, 6%? Does anybody know? Negative. How can that possibly be? You get negative interest? You have to pay somebody to take your money? How did this happen? And what does it mean? Let's explore that, and let's step back and see why that has happened, and then try to figure out where it's going, because it has an enormous effect on everything, including the insurance sector. The journey is really an economic one, and I'm not going to get into the politics or the social, cultural aspects, but they're all interrelated. And what's going on in the world today in the economy has a lot to do with a lot of the other factors going on. So I'd like to level set and bring everybody kind of along a journey. And this story, I think, would be very interesting if it weren't for the fact that it's true. And this story starts with our free economy. And we have a capitalist system that has lots of swings to it. And it goes up and it goes down and it goes through crises and it goes through ebullient boom times. I think that's extraordinarily important. If we had a controlled economy, we wouldn't have entrepreneurship, creativity, growth. So you need to have these wild swings. But in 2004, 5, 6, the swing got way, way out of control. No money down. Why don't you buy the house next door as well as the house you own? Invest in this, invest in that. Trees grow to the sky. It's different this time. Unregulated, wild and woolly period. And unfortunately, when the pendulum swings like that, and it's way, way out there, it doesn't correct to equilibrium. And frankly, we wouldn't want it to, because that's too controlled. We need to have this freewheeling economy. So when that happened, and we all knew we were in some sort of a bubble, although Bernanke and Paulson and everybody said housing prices never drop at the same time across the country and all the other misstatements at the time. When that swung back, it didn't swing to equilibrium. It swung way over here. And it was the biggest crisis that we've had since 1929. And we can get into why it happened, but it was a very serious problem. And as Warren Buffett likes to say, when people are greedy, be fearful. And when people are fearful, that's actually a better time to invest and to do things, because when you're over here and you're responsible for capital allocation at a private equity firm, that's a terribly difficult time to invest. When you're over here and everybody's moaning and groaning, that's actually a good time to invest. So we get over here, all of a sudden, we've got a whole different scenario. In 2008 and 2009, every single bank in the United States, the big banks, were technically insolvent, which means if you had marked their assets to market and paid off their liabilities, they had less than zero value. Every single bank. The regulators knew that. If anybody had announced it, it would have been a disaster, so they didn't. They just kind of rope-a-doped. And the government did a lot of things that basically saved the system, because it was close to going off a cliff. Now, what did it do? Basically, the government started printing money. And it has two, as everybody knows, it has two levers to try to get an economy stabilized and growing again. One is fiscal policy, and one is monetary policy. Fiscal policy would be spending more money, building bridges, roads, tunnels, highways, creating jobs, creating growth, which the president and Congress couldn't agree on, so they never really could use fiscal policy, and you now see the new candidates suggesting that, and there's a lot of benefits to fiscal policy. But in 08, 09, there was no appetite between Congress and the president to do that in a meaningful way. So they're left with monetary policy. And what is monetary policy? As we all know, monetary policy is just the supply and demand of money. And so the government printed tons of money and created low interest rates and artificially wide spreads. And so the banks could basically earn their way back to solvency by having these artificially created wide spreads. So the banks earned their way back to solvency. They raised a whole bunch of new capital, which they could do because of the profitability that the artificial spreads gave them. They took write-downs to where the loans really were valued. They shrunk their balance sheets enormously, and they became heavily regulated, heavily capitalized, and basically very safe. Our banks are very safe. Their problem today is profitability and being able to do things to help the economy grow. It's not that they can't pay their debts and they're going to be insolvent. Meanwhile, the European banks did nothing. They didn't do any of that stuff. And Kathy mentioned I'm on the advisory board of Deutsche Bank. Deutsche Bank is Germany Inc. It's a multi-trillion-dollar bank. It will be there forever. As long as Germany exists, Deutsche Bank will exist. But it was just designated a month ago the most dangerous bank in the world, which sort of sounds like a James Bond movie. But basically, it's a multi-trillion-dollar bank that has shipping loans and all kinds of lendings that they have not marked down to market yet. And so a few years ago, the European Union decided to take the playbook of the United States. Let's lower rates and let's let our banks earn their way back to solvency. Well, there was a big problem with that. The spreads were gone. The spreads were very tight. There was no artificial spread. And so the oxygen pumped into the system did not allow the European banks to get well. So what did they do after that? They decided to try negative rates, which is just an unfathomable concept. It's hard to even understand. In 500 years, there's never been negative rates. And today, in a world of $60 trillion of debt around the world that you could invest in if you wanted to buy a Procter & Gamble bond or a Japanese government bond or any debt instrument, 25%, over $12 trillion, has a negative interest rate. And so why would you invest in a negative interest rate instrument? Well, if you're an individual, you might put your money in the mattress. In fact, in Japan today, it's very hard to buy a safe because the safes are all sold to people who are putting their money in the safe, because why do they want to give their money to somebody who's going to charge them for the money? But if you have $5 billion and you're an insurance company and you got $5 billion in Germany, you can't really put that in the mattress, and you wouldn't want to put that in your safe because that sounds a little dicey. So what do? And why is the government charging you to take your money? And the answer is, conceptually, they want you to not invest in the government bonds. They want you to invest in riskier securities because they want you to pump your money into the system and make it grow and develop faster. And the problem with that is yesterday's Wall Street Journal, front page, negative rates, big surprise, more savings. What has happened is people are looking at that and they're saying, whoa, something's wrong here. This makes me very uncomfortable. This isn't going to make me want to spend more. This is going to want to make me save more. Because number one, I don't know what's going on. And number two, if I did know what was going on, I'm not going to get paid much to invest in something risky, so I'm just going to save. So far, it's backfiring. But it's an incredible phenomenon. And again, it's just, if you have studied money and if you have looked at the way the world moves, to have $12 trillion of negative interest rate securities is just hard to imagine. So we're in this incredible world where the journey is, up until now, very interesting. And if you're an economics professor at the University of Vermont, it's fascinating. But if you're a business person and you're trying to live in this world and you're trying to understand where it's going to go, it's very, very tough to know. So the United States, a couple of years ago, several years ago, did this QE, and everybody knows what the QE ship is, but QE was quantitative easing. That's when they started printing money to try to put oxygen back in the system in 08, 09, 10. And QE was working. Rates were going down. All asset prices were rising. And it was okay, but not sufficient. So they went to QE2. And QE2 was not another cruise ship. It was the second wave of printing, and they printed more and more and more money. And this is like somebody that's on oxygen. If you shut the machine off, can they breathe on their own? Nobody knows. Nobody knows. So they decided in the middle of QE2, let's taper. Let's kind of slow this down and kind of see how, take a little oxygen away and see what happens. Well, the world had what was known as a taper tantrum. And the markets went nuts and said, what are you kidding me? Give me more of that oxygen. So the government did a complete 180 and turned the oxygen back on. So who knows what the economic body can handle without oxygen, because they've tried to tinker with it, and when they've tinkered with it, they got the taper tantrum. And so today, the U.S. government is still leaving the money out in the system very flush and very significant. The other aspect of this is, and this was certainly not something the government wanted to do, by pumping oxygen into the system and propping up all these securities and all these investments that people had that were underwater, they basically made the wealthy people a lot wealthier, and the poor people got left behind, because the poor people didn't own stocks and bonds and didn't have these investments. So the world got bailed out in a very artificial way, and that has created a lot of the issues that we obviously see on TV every day with politics, et cetera. So it's an amazing phenomenon. I would just highlight one thing, because it's very important at Stone Point, it's very important in insurance, and it's the single most important thing we teach ourselves and remind ourselves at Stone Point every day, and that is supply and demand. That class I did listen to, Kath, like the third time I took it. Supply and demand is the single most important tool you can use whenever you look at anything. And that's what these governments are doing, and that's what money is all about, and that's what decides insurance rates and everything else. So I would keep a very close eye on supply and demand. Now, moving right along here, this is a very difficult environment to invest in, and the implications are enormous for insurance. The CEO of one of the biggest property and casualty insurance companies in the world said to his investment department, the first investment anyone here makes in a negative yielding instrument will be the last investment they'll ever make at this company. I think if you step back and think about who that was, you would be able to guess, because that's kind of his style. But that's a tough thing. So what does that mean that insurance company is going to do with their $5 billion in Germany or their money in Japan that they can't move out? That means they're going to invest in riskier securities. And listen to some of these statistics. This is, by the way, I'm very positive on the economy in the world the next couple of years, but you wouldn't know it. But in 2008, debt levels were sky high. I could take you through the numbers from the 90s to 2000, 2008. They were up exponentially in 2008. And lots of defaults, lots of bankruptcies, lots of problems without this oxygen machine. They turn on the oxygen machine, and listen to this. In 2008, U.S. and European high-yield markets, $780 billion outstanding. Today, that 780 has grown to 1.7 trillion. It was sky high then. Pump up the system, it's more than doubled. European banks have over $2 trillion, 2 trillion euros actually, of what have been labeled non-core assets. That means I want you out of this. You don't have to do it tomorrow, but get out. They have sold 145 billion of these 2 trillion. So they still have all of this stuff on their balance sheets marked at 100 or 98, and it's worth 70, 60, 50, whatever. The U.S. investment grade market was $2.5 trillion in 2008. Huge number, way more than people thought it should have been. That $2.5 trillion today is $5.3 trillion, more than double. Emerging markets, a great place to get more yield. We've all traveled on vacation to some of these places, but you don't really want them to have to pay you back. Thank you, Argentina, every 25 years. 117 billion in 2008, 562 billion today. So I could give you 10 more numbers, but the debt in the world today is unbelievable. And why is that? Because we pumped it up with oxygen, we artificially inflated pricing, and we induced people and institutions to invest in these places. So this is really a scary phenomenon, and nobody knows how this thing unwinds. Nobody knows what's next. We all rely on pattern recognition. There is no pattern recognition. UK just lowered their rates. They're lower than they've been in 322 years. I mean, even an old person like I wasn't here then. I mean, 322 years ago. How can you know where we're going from here? So, scary stuff. How does that relate to insurance? The insurance markets, as everybody knows, companies have two sides of a balance sheet. On the liability side, they take the risks that you offload to them or you take yourself, and they try to make money or not lose too much on the liability side. On the asset side, they invest. Well, right now, there is a huge amount of money in the system competing for those insurance risks. So the pricing of those risks, one could argue, is not exactly robust for the person taking the risk. It's great for people that are offloading the risk. And on the asset side, you're dealing with these low yields, negative yields, and you're being induced to take risks, buy emerging market debt, do things you don't really necessarily want to do with your money. So this is big casino stuff. And when I think of my 5th grade paper on money, and I think of where we are today, I don't have a copy of that, but I doubt it had much in it that would give me enlightenment. So let's talk about insurance. And I want to get to some of the comments that Rich alluded to on disruption and technology and the Uber era, et cetera, because some of that stuff is really interesting. But first, let's just talk about insurance, because as the last speaker said, we got to recruit young people into this industry. I think this insurance industry is a phenomenally interesting business. I am fascinated by it, and it was the last of the financial services industries that I was ever exposed to, from commercial banking to investment banking to asset management. And insurance is just an amazing industry. And an aha moment I had, how many people here have ever been to the Ocean Reef Club? So I'm at the Ocean Reef Club playing golf, and by the way, I'm not a good golfer, but that was a nice comment. And I'm on like the 3rd hole, and I hear this big sound, and the golf course is right next to this private runway. And down comes this big jet landing, and it's Bill Berkeley of W.R. Berkeley. And about 15 minutes later, I'm on another hole, and I hear this big roar, and this other big jet comes down, and it's Hank Greenberg. Thought, that's interesting. About 20 minutes later, another roar, and it's another big jet, private jet coming in, and it's Carl Lindner. I thought, what do these 3 people have in common? Well, they all are flying around in private jets. That's pretty neat. The answer is insurance. There are so many billionaires that have come from insurance. Jack Welch made his career in insurance. Warren Buffett, it's his main thing. Prem Watsa, Berkeley, Greenberg, they're all over the place. You can't find billionaires of any number in banking, investment banking, or any of the other areas. Insurance is actually the most exciting entrepreneurial, wealth-creating sector of all of financial services, and yet it's viewed as regulated, boring, dry, whatever. But let's get underneath what it is. It is an incredible form of, in effect, legalized gambling. And what really matters in insurance, supply and demand, obviously. Everybody knows about frequency and severity, right? Frequency and severity. If auto accidents, fender benders are very frequent and they're not very severe, hopefully not to the human body, but financially they're not very severe. Earthquakes are very infrequent, but they cause massive losses. So everybody's always looking at frequency and severity, supply and demand, short tail, long tail. Short tail risk is an auto accident. You don't wake up 3 years from now as an insurance company and find out somebody's reported an accident from 3 years ago. You sort of know in the year that it's happened what your losses are going to be. That's short tail. Asbestos and other things can come hit you 20 years later. That's long tail. And so short tail, long tail is a big factor. How many people know what float is? Okay, float is a concept popularized by Warren Buffett, which is that in insurance you get money up front in a premium and you pay the claim later, if ever. And the shorter tail risk, the good news is you kind of know what your losses are. The bad news is you can't do much with that money because you need it pretty quickly to pay off a claim. Long tail risk, the bad news is you have no idea really what the magnitude of that's going to be, but you have a lot of time to take the money and invest it before the workers' comp claim or whatever the long tail risk is comes to pass. So you're in a situation where the short tail, the long tail, the frequency, the severity, the supply, the demand, all these nooks and crannies come together. Now, the other thing that's amazing about insurance is I call it basically very unregulated, which surprises people. But if you're running a bank, you have deposit from someone. What can you do with a deposit? You can buy a government bond or you can buy a mortgage security. You cannot buy a corporate bond. You cannot buy a stock. You cannot buy a high-yield instrument, and you can't buy real estate or other assets. An insurance company gets $1 premium. What can it do with it? The answer is anything it wants. Not with all of it, but with some of it. You can buy a golf course. You can buy a gaming casino. You can buy Argentinian debt. You can buy anything you want, which is one of the reasons why so many smart people have made so much money in insurance, because there's a lot more flexibility in what you can do in insurance than there is in what you can do in banking. So it's a very exciting industry. It's completely necessary. It's changing all the time, and it's in the middle of everything. Nothing happens in the economy without insurance. Ships don't sail, trains don't run, planes don't fly, nothing happens. So it's an amazing business. Let's talk about the Uber era. The insurance industry that we have addressed over time, we're waiting for dislocations. So after the big, if anyone's old enough to remember the terrible dislocation in the mid-'80s, which hopefully not many people here are old enough to remember that, basically you could not get directors and officers liability insurance for a big company. So if you're DuPont, Chase Bank, GE, General Motors, in the mid-'80s, you couldn't get anybody to serve on your board because the risk was too great, because all of a sudden D&O, E&O exposure was developing. So Marsh & McLennan, we all have our Marsh shirt on, set up the Trident funds, and our platform was born by creating ACE and XL, which basically happened because all of the Marsh brokers were being yelled at by all of the risk managers, I need this insurance. They went all over the world, and they couldn't get anybody in the world to write this policy. And so they decided, let's set up a new company. They set up a new company, they hired J.P. Morgan, and they couldn't raise money to fund the companies. So they went back to Chase, General Motors, DuPont, General Electric, and they said, if you want this coverage, you're going to have to write me 2 checks, one for the surplus of the company to fund it, capitalize it, and then one for your premium. And so all of them wrote those 2 checks. They took their policy to their board and said, got it for you. And they took their investment in these companies, ACE and XL, and basically wrote it off and put it in a drawer. Little did they know one of them would go up 30-fold in value and the other would go up 15-fold. But that's how that imbalance was addressed. After Hurricane Andrew, we set up Mid-Ocean to address that imbalance. After 9/11, a terrible human tragedy, but also a big insurance dislocation, we set up Axis and funded Arch. After Katrina, Rita, Wilma, we took Chubb Re out of Chubb, and AXA Re out of AXA and formed Paris Re and Harbor Point. And since then, there really hasn't been a big dislocation. And so we're waiting for more dislocations. If the wind blows tonight in Florida, our phone will ring off the hook tomorrow. Rates are up. How do we put capacity into the market? Fortunately for us, there have been plenty of other dislocations, like the credit cycle and other things for us to do while we wait for insurance to come back to a supply and demand equilibrium or bias where we have a asymmetric risk and reward opportunity. So that's really what we do, and that's what people give us money to do, and that's what we're waiting for constantly in the marketplace. We also do a lot of distribution and brokerage. We also do we own a software company called Vertifor. We own Sedgwick, which many of you use for your TPA services, and other things in and around insurance, but they're all related to supply and demand and dislocation. The Uber era, let me talk about that in three ways: underwriting, distribution, and alternative capital. Let's start with auto insurance. I'm on the board of Progressive, so I have a window into auto insurance. Auto insurance is 35 or 40% of all premiums in property and casualty. Everyone has to have it. It's short tail. It's high frequency, low severity. Again, not to minimize the damage that happens in an auto accident, but in an insurance context it is. There are hundreds and hundreds of competitors. You can get 25 quotes on insurance. And it's a slow or no growth business. So how does it deal with the disrupting era that we're in today? Well, first of all, it's a scale business. Brand is very important. The big guys, Geico, Progressive, Allstate, State Farm, spend almost $1 billion a year on advertising. And technology spend is huge, over $500 million a year, the big folks spend. And it takes great underwriting acumen, because there really are, who here knows when the next earthquake is? Nobody. Who here can tell you with millions of data points how many accidents there'll be today, or how many there'd be in Texas if there was a hailstorm? That those numbers are large enough so you can do actuarial work and you can actually have some pretty good estimates. So there's a lot of acumen there. Direct distribution, a huge issue. Brokers make about 15% on a commodity product you can buy from 100 places. And Progressive and Geico now are the big direct players. Progressive now, you can take your iPhone, take a picture of your license and your registration, and ask for a quote, get a quote, bind online, be billed electronically, and you're done. Now, when you think about how hard it is to get auto insurance and all the forms and all the stuff, that's the world of tomorrow. And that's what the 22-year-old is doing. Well, fuddy-duddies like me still go back to our insurance agent. So that's an incredible world. You wouldn't want to compete with Progressive and Geico without scale, technology, underwriting acumen, brand, and all these things. But if you're in their shoes, what about driverless cars? What about peer-to-peer? What about ride sharing? And what about autonomous vehicles? There was a research report recently that auto insurance will go from $200 billion a year in premium to 50, because frequency is likely to go down if the vehicles are autonomous. Now, the severity is worse because the technology in cars today is very expensive, and you have a fender bender and it costs a lot more than it used to. But it's basically a business that it's not going to grow, and it's highly likely to really shrink, and that's 35 or 40% of the premium dollars in the United States. Progressive views the car as the ultimate mobile device. So I think you're going to see an incredible amount of change in what your car can and will do. You see the Wi-Fi ads now, and et cetera. And Progressive has been the leader in credit scoring and other predictive mechanisms. You own a home, you have an educational degree, all these things have a parameter towards your driving patterns. But Progressive now has something better than estimating your driving behavior. They have your actual driving behavior. And if you get a snapshot device and put it in your car, they know exactly how you drive. So that world is really already being disrupted, and pretty hard to see somebody coming in there and taking the 35 to 40% of the insurance premium dollar away from these folks without all those factors that I just mentioned. And a lot's going to happen there with autonomous vehicles, et cetera. Insurance more broadly, you've all probably read about Ajit Jain and Berkshire Hathaway now going direct in commercial insurance, which has basically never been done before. And they're taking their Geico model and trying to do that. AIG is run by a very high IQ man who comes from banking, who was instrumental in developing the credit default swap at JP Morgan, Peter Hancock. He has hired 130 PhDs who have no insurance background, and he's saying to them, I want you to Billy Bean the insurance industry. I want you to look at this in a way that it hasn't been looked at before, and let's change the way the business is done. So the big folks, the big legacy players are changing dramatically. Berkshire Hathaway, AIG, you could talk on and on about a lot of them. New entrants, venture capital, the Silicon Valley. There's been a tenfold increase in the last 2 years in money going into fintech. Most of the fintech money is going into payment space, wealth management, lending. You've all read about Lending Club and these peer-to-peer lenders. Very little's gone into insurance, but it's coming. But this is tricky. This is tough stuff. And Sequoia has backed. Sequoia is a big venture capitalist in California. They've done a lot of the big successful venture deals. They just put $13 million into a company called Lemonade. And Lemonade has people from AIG and ACE and people that really understand the business, and they're rolling out their model. But it's $13 million. And so there isn't a lot of money yet, but it is coming. But people forget that in the late 90s, the internet was going to change the world. Everything was going to change. And actually, Sequoia backed a company called InsWeb, which some of you may remember, and it still exists. But InsWeb went public, had a big multi-billion-dollar valuation, and then on March 12th, 2000, some day like that, the NASDAQ market and the internet bubble burst, and those stocks went down 95 to 100%. It took 15 years for the NASDAQ to get back to where it was in March of 2000. It didn't happen until last year. 15 years. So now we're back, and if you'd said 15 years ago, people are going to go to sleep for 15 years and not do anything to change insurance and fintech, you'd have said, no way. But that's what's happened. So now it's back again, and all I can say is the world will change, but 9 out of 10 of these folks are going to go home in tears because it is tough. And if any of us were around when the automobile was invented, or steel mills, or the telephone, for every Alexander Graham Bell and Henry Ford, there were 100 people that went bankrupt. These things, these disruptive things are, there are Ubers, there are Airbnbs, but most people don't come out the other end. So it's a very tricky business, and we'll see how it goes. Distribution, why in the world does the world need, from the insured to the insurer, a retailer, a wholesaler, a reinsurer, a reinsurance broker, a retro broker, a retro insurer? There's too many mouths to feed. If you look at other industries, how much of the value of a product that somebody buys are they getting back for every dollar they spend? In insurance, the actual losses are about 56 cents. Some markets 53, some 58, but say 56 cents. That means 44 cents of every dollar you spend is being taken by somebody who's in the middle of the transaction. And in today's world, is that person really necessary? If you can just pick your phone up and bind online and do all these things, do you need all these intermediaries? 56 cents is too low. And is it going to be 60, 80, 90? Every other industry has figured out how to squash that. When I was at Goldman Sachs, we were approached by Guy Carpenter, the Marsh insurance broker. This is now over 20 years ago. And basically, Marsh Mac and Goldman both saw a phenomenon, which is the capital markets, the most efficient market in the world, is going to take over the reinsurance business. Why not? I mean, if you can do a parametric bond where the city of Tokyo gets paid their insurance benefit if there's a hurricane of over 5.5 on the Richter scale or whatever, it's parametric risk. You don't even have to worry about reading the policy and the claims. So the cat market's going to take over the reinsurance market. And so Guy Carpenter came to Goldman and said, you know the securities markets, we know the reinsurance world, let's merge and put our insurance businesses together. That was literally within a week of being signed, and it didn't happen. Somebody at Marsh Mac and Guy Carpenter said, whoa, we don't want to do that. Goldman will end up getting in here, fox in the hen house, Trojan horse, whatever. We didn't know what that was all about. 5 years later, I end up at Marsh Mac, and I meet all the people that were on the other side of it, and that's exactly what they thought. But that was 20 years ago, and you would have said by now that market would have taken over the reinsurance world. Well, headline 2 days ago on the front page of the Wall Street Journal about how the cat bond market's finally taking hold, finally reaching critical mass. But who would have thought that would take 20 years? It's amazing. You know, the banking system used to have something called 363. And 363 was, I take the deposit in at 3%, I loan it out at 6%, and I leave at 3 o'clock in the afternoon. And that went on for decades. And then along came the commercial paper market. And the commercial paper market said to General Motors, IBM, Procter & Gamble, instead of borrowing money from Citibank and JP Morgan, who are taking 300 basis points of profit to cover all their bricks and mortar and overhead, I'll do it for 1/8 to 1%. I'll do it for 12.5 basis points. So all of a sudden, IBM borrows from the commercial paper market. The securities market, much more efficient. The broker putting them together doesn't need the bricks and mortar. And that 12.5 basis points went to 10, 8, 6, 4, 3. How do you compete if you've got branches and infrastructure and that huge overhead base with a handful of people sitting on a trading desk facilitating money from corporate treasurers and pension funds and endowments for 3 basis points? You can't. And the same thing's true in insurance. And that's what Nephila is. That's what a company we own called New Ocean is. It's a handful of people taking no risk, placing business in the capital markets for a very small fee. So where is this 44 cents going to go when people can do that? And again, why is it taking so long? Banks then smartened up and started becoming in the moving business, not the storage business, which means banks used to originate and hold. All of a sudden, 30, 40 years ago, banks originate, package, sell, service. Insurance companies still originate, hold. Now you're going to see originate, package, sell, service, which means that if you control the customer, you still have a raison d'etre. And if you're adding value, you still have a raison d'etre. But if you're sitting in between these giant markets and you're charging 44 cents to do what you do, that world is coming to an end. But again, 20 years ago, if I were standing here, I would have told you that game's over. Here we are in 2016, and the vast, vast majority of the business is still done that way. So there's going to be huge disruption in the distribution channel and in the place between the person that wants the risk and that wants to insure himself against the risk and the person that takes that risk. And they don't need much to get them together in today's internet Uber world. And that's where alternative capital comes in. And alternative capital is really an amazing thing. You've all read about these hedge fund Res, and they try to invest instead of at anemic rates like we talked about a few minutes ago. They try to put money into high-yielding securities and get 10% return on their assets so they can charge you less on the insurance side. Those models so far haven't done particularly well on either side of the balance sheet, but they're raising lots of capital. So those are some of the phenomenons that we see, and I would just tell you it's never been more difficult or more treacherous to invest for us. We are trying to figure out all these things we've been talking about in the overlay of this massive oxygen machine that we have no idea who the decision makers are and how they're going to make those decisions around the world, and that has a huge impact on insurance. We are looking at all these disruptors and the Elon Musks and Steve Jobs of the world that are going to look at insurance and say, I want to do to that industry what I did to other industries. And meanwhile, we're looking at a market where on the liability side, it's very tough to find a risk today that you think you're being paid adequately to take. And it's very tough to take that money, even if it's long tail money, and invest it in something you feel good about investing in, because all these safe things are yielding little or nothing, and all these risky things that the governments want you to invest in to prop up the growth of their economies there's too many people chasing those. And again, supply and demand, when too many dollars are going after that, the price of those has gone up so much that you look at it and say, I am not getting paid to take that risk. So it's a very intimidating time. It's wonderful to be a captive because you all, and Kathy and others here know a lot more about your business certainly than I do, but you have the ability to offload risk. You have the ability to keep risk yourself. The capital markets are available to you. These new directs are going to come in. There's a lot of hedge fund money that wants to share your risk with you. So it's a great time to be in a position where you can decide what risk you want to take and what risk you don't want to take. But trying to figure out where we're going to be in 2 or 3 or 4 years, to me, is a pretty intimidating prospect. And again, I would love to be an economics professor at University of Vermont because this is what I dream about, just these incredible global experiments. And that's what it is. It's a great big science lab, and nobody knows if it's going to blow up or create the most wonderful world known to all of us. And it relates to the political situation, and it relates to the social cultural situation. So again, I think we're all in, we've all got a seat in the stadium, and put your seatbelt on and enjoy the ride. Thank you. I have a question here. What will blockchain technology do to the commercial and captive insurance industries? Wow. I live in Greenwich, Connecticut. My son rode with the Winklevoss brothers, and they invented Facebook. And they hired this little nerdy guy named Mark Zuckerberg to program for them, and they went off to heavyweight crew at Harvard, and they came back, and he took the business from them. They are now big in Bitcoin and blockchain. I can barely spell those things. I have no idea how this functions or works. I would personally not want to bet on it happening or not happening. I think, like the insurance industry, the infrastructure in the payment system and the railroads and the regulatory morass and the technology is so built in. There clearly is a role for blockchain, Bitcoin, other forms of currency. I'm glad it didn't exist when I wrote that paper about money in 5th grade, because I wouldn't have known what to do with it. So I really don't see it happening as quickly or as excitingly as a lot of people think. There's fraud, there's copying, there's patents, there's different governments and regulations. I think it's going to be a very hard thing to overlay on the existing system. Yes?
So, in terms of disruptors in the insurance business, I think you just touched on the biggest, from my view, which is the fact that it's regulated. And it is, from my view, heavily regulated.
Mm-hmm.
So, how is the global economy and insurance going to address the disruption of state-by-state regulation?
Can you repeat the question for everyone?
Yes, the biggest risk in insurance today, in Mike's mind, is regulation, and the industry is very heavily regulated. And he's right. I said it was not all that regulated, and I really was talking about what you can do with the premiums that you receive. But because they're state by state, and there's always been an effort for the federal government to take it over, and it never seems to happen, it is very heavily regulated. Personally, I think the regulations are challenging and difficult and make it hard to get off the ground. But once you reach critical mass, in many ways it's a barrier to entry, and it keeps the industry kind of where it already is. And nothing in the financial reforms and Graham Dodd and all that stuff really hit the insurance industry that hard, because the insurance industry really had nothing to do with the credit crisis. I mean, AIG went belly up because of things they were doing in mortgage derivatives. It didn't relate to property and casualty insurance. It did relate to mortgage insurance. They were betting that on the residual value of homes, which, of course, never drop at the same time all over the country, that we all, famously heard. So I don't think the industry's regulatory environment has tightened. If you're a bank today, it is awful. I mean, Jamie Dimon has 1,000 regulators inside his bank, sitting next to his people every day. He's spending billions of dollars just filling out forms and regulations that he wasn't doing 10 years ago. AIG obviously has got lots of issues, but most insurance companies today are living in the same world they were living in 10 years ago. So you know more about regulation than I do. I don't see regulation easing up very much. It's very hard to get different countries to agree. It's certainly hard for states to give up the employment and the responsibility and the power over regulation. So I think that's just something you live with. I think it will slow down change. I think it will help the incumbents because it's a barrier to entry, and it requires scale and mass and having lawyers and filling out forms and doing all the stuff that regulations require. But it has kept the industry, out of big trouble. So it's hard to say it's broken, other than it's definitely, kind of heavy lifting cost-wise. You see it differently?
No, I absolutely agree with that. Yeah. I think it's one of the things that will slow down innovations like. I think it's one of the things that will slow down innovations like blockchain and others.
Yeah.
And even in personal auto, Progressive still has to get 55 regulators to sign off on whatever it is they want to do. So I think it's going to slow all that down.
Do you think an auto accident is in an autonomous vehicle will be viewed as auto liability or product liability? That's a great question. Progressive just announced that we just signed up a relationship with Uber in Texas. Obviously, that's a test pilot, but we're spending a lot of time. Our people are spending a lot of time with Google, with Uber, and trying to figure all this stuff out. And the Uber risk is the car, the driver when he or she is going somewhere, not doing an Uber assignment, just going to the grocery store for his family or her family, and then it's when there's somebody in the car that's different than the person that was in there an hour ago. So it is a complicated insurance risk and exposure, and I think the idea that it will become a product liability or a personal liability, I think all that is TBD. Progressive has views on it, Uber has views on it, but I think it's TBD. Oh, here's a good one. The most popular question. What makes you bullish on the world economy in the next 2 years? Whoa, did I really say that? It wasn't in my notes. I am very bullish on the United States in the next few years, and the main reason is the consumer. Housing prices are not artificially propped up. The amount of disposable income that goes into servicing a mortgage is under control. The consumer's 2/3 of the U.S. economy. Corporate balance sheets are very strong. A lot of the debt they've raised is longer-term, fixed rate. I just think that our economy is in pretty good shape. I think our government political situation could be certainly a disruptor to that, but I believe that we are the tallest midget in the kingdom in terms of what's going on everywhere else. Europe is just literally, they have not faced up to their problems, and they are going to go through a very tough period. And the Japanese are, they've got a demographic problem with aging and retirement, and Japan's an amazing place. It's the size of California. It has no energy reserves like oil and gas. It has no grain belt. It's just all mountains, and its economy has stalled, and it's been stalled for 25 years. So they're having real challenges. The Chinese are the largest investors in our fund, although we're not allowed to say that. Can you keep that in this room? The entity that invests with us doesn't want us to use their name, but so we spent a lot of time talking with them, and somebody told me something the other day that was horrifying, because I've never thought a Chinese national would tell an American this. They said the federal government in China pressures the provinces, and the provinces pressure the businesses. So when you give the province your data on your sales and your growth, they are beating you up saying, that's not enough. Lie to me. Give me a higher number. I need a higher number to take to Beijing. So the numbers we see about the growth in China, there's no way to know what's really going on there. And they got very serious problems. And the problem with China's problems is now they're so big that they reverberate around the world. So I think Europe has got a long slog out. I think Japan has got serious problems growing. I think the Chinese will have a lot of challenges getting their population under control. The one child policy was so amazingly disruptive and bad for their demographics. They now are changing that, and they're trying to get young people, but they have a 25-year gap in age people, so they've got a huge demographic problem, way worse than ours. And that's one of the biggest problems in the world, because the retirement commitments to people in public and private sectors are much greater than the assets that those plans now have. Our biggest investors by far are the state pension funds and the corporate pension funds of the United States. And we have most of the big states, and we have 15 of the top 50 corporate pension funds. And we meet with these people all the time, and their liabilities are growing very rapidly with healthcare costs and retirements, and their assets are, because of what we talked about earlier, it's very tough for them to make 8% or whatever the number is that they think they have to make to pay their bills. So it's very tricky. But I think the United States is solid, and the consumer is under control, and we don't have the kind of bubble that we had in 06, 07. Yes?
Even though there's been a lot of turmoil in the world, there hasn't been a significant insured cat loss in many years.
Yes.
And when there is a $50 billion or $100 billion loss, what happens to the alternative capital that has been rushing in to issue cat bonds and hedge funds and such?
That is the $64,000 question. Everybody asks that because it has been a great place to invest and there haven't been losses. The yields are going down as more money comes in, so the risk reward is not as great as it was. I personally think it's now here to stay. And I think if it gets hit with losses, it will pull back, but it will not go away. And there's enough pension funds and endowments that have committed 2% of their assets to the category, and there's enough technology now on Wall Street and in the securities markets that I think that the money will flow. So I personally don't think it will be that disruptive. And the other thing is that the world is now, the insurance industry's generated so much cash flow from not having to pay cat losses that the capital positions are enormous. It would take a very large event to change the supply and demand imbalance. There's been a lot of mergers, which Rich referred to, which have a big impact on the industry. Ace Chubb, things like that. Travelers is rumored to be going after Hartford. There's all kinds of stuff going on in consolidation, and people have been buying back their stock a lot. So not all the money stayed in the system, but if there were a $200 billion loss, it wouldn't be a day where everybody said, "Oh my God, we're going to go bankrupt. We can't pay our claims." So I think it'll last, and I think it's finally here to stay. But again, I would have said that in 1998, 2004. Mike Millett, who is the number one cat bond person on the planet, loves to tell people that he reported to me for 7 years at Goldman Sachs, and every year I was pressured to shut his department down. And I kept saying, no, it'll be okay, and it never was okay till long after I left. Goldman had way more than a 50% market share in cat bonds for years because we just thought this is where the world's going. So I think it'll be slow. It's now on the front page of the Wall Street Journal, and everybody knows what it is. You go to Harvard's endowment or GE's pension fund, they all know about it. It's now part of the investment psyche of people. It's a category unto itself. I don't think it's going away, and I think losses will change the sophistication of the people that invest, and there will be some people that will say, "Whoa, I didn't know I could lose my money." But I think the majority of it's pretty sophisticated money now. You disagree with that? Okay, we'll see. There's a question here about, do you think people will be reluctant to go direct for fear of alienating the brokers and the agents? That's a great question. And when I started in this business 18 years ago, a very wise man said to me, "You know something?" Because I looked at the brokers and I said, "How do they survive? They make so much money in the middle. They take no risk, high margin." And he said to me, "If there were a nuclear holocaust, two things would survive in the world: cockroaches and insurance brokers." And you know what? He's right. And the reason is they're high value added. They're on the balls of their feet. They hustle. They move risk around. They satisfy client needs, and they control the client. They're on the front end. I mean, one of the smartest people in insurance that I know, V.J. Dowling, who writes the IBNR stuff, he says that the best positioned people for the new era are Marsh and Aon, because they control the customer, and they've got everything but the capital. They've got all the risk metrics. They've got all the analysis. They should own Sedgwick, which we'd be happy to sell them, by the way. Anybody here from Marsh? It's a great company. They have all of the expertise, and all they need is capital on the back end, and the capital's going to come for reasons that we were talking about. Because if Marsh took to the capital markets insurance risk, people would do that. So I think that, we started a company 11 years ago called Pure Privilege. It's a high net worth personal lines insurance company. I highly recommend it to anybody who is interested in personal lines. Kathy has helped them. And they started from scratch. And they are now in a oligopoly. I didn't say that. Oligopoly. Because Fireman's Fund threw in the towel and sold their renewal rights to ACE. ACE merged with Chubb, and so it's AIG, Chubb, and Pure. And that's it. And now everybody wants to get in the business, Liberty and Nationwide and Markel and XL, but we got an 11-year head start. We will not go direct. We don't want to alienate the brokers because we think the brokers add a lot of value, particularly for people that have $1 million homes. They rely on their brokers, and if somebody comes to us direct, we recommend a broker to them. So Pure doesn't want to go direct. Progressive had a brutal decision years ago because they're the largest independent agent auto insurer in the country, and they decided to go direct. Geico doesn't go through agents, so they don't have the dilemma. And the agents went crazy. And Progressive's reaction was, we are going to offer our product to the consumer however he or she wants to buy it. If they want to buy it through you, that's great. If they want to buy it direct, online, on the telephone, progressive.com, that's not our issue. Our issue is, here we are, come to us through whatever channel you want. And they have sort of been able to get away with that. But I've met many agents that say I sell as little Progressive as possible because A, they give me 10%, not 15, and B, they compete with me. So I think it depends on who you are. It's tough to go around brokers because they control so much business. Without getting into a big monologue, the way Aon and Marsh have set these Lloyd's vehicles up, I mean, there's some packages now that have a 35% commission rate to Marsh and Aon. 35%. I mean, it's incredible. So they're powerful. So I think you got to think twice going around them. It depends on your business model. But I think over time, there's going to be less friction costs between the insured and the insurer. We should shut down anytime you want, but outside of insurance, what is one word of advice you would tell young people, college students? Wow. If you read Charlie Munger's book, Warren Buffett's buddy, who's now 90-something, guy's amazing. If you ever go to the Berkshire Hathaway meeting, he sits with Warren in front of 40,000 people, not including the people that are streamed in by video, and he eats peanut brittle, and he falls asleep. And then he wakes up, Warren says, "What do you think, Charlie?" And he wakes up and says something. Very interesting book that he just, that was written about him. He's made